Welcome back. Three big U.S. banks reported earnings this morning. It's our top story. Let's get reaction now from David Burrows, President and Chief Investment Strategist at Barometer Capital Management. David, great to see you. Happy Friday to you. The market is turning thumbs down to these results. What do you think of these numbers? I know you've got J.P. Morgan Chase as a top holding on behalf of clients.
Yeah, you know, the financials went for many years underperforming, and in 2021 broke out to new highs, sort of from the 2007 highs. J.P. Morgan broke out to new highs in 2013, so clearly the leader in the group. You know, these numbers are good numbers that are being reported. The large U.S. banks have a tendency to weaken for a day or two after their earnings reports. But I think it's really notable that all of the major banks, Citi, Goldman Sachs, J.P. Morgan, all made fresh all-time highs this week. And it's been a really obviously interesting week in the market. Yesterday was quite a day, but in general, the banks are beating on trading revenues, which the market doesn't always want to pay a multiple for, but they certainly beat on mergers and acquisitions revenues and advisory revenues by like a wide margin. They're all taking slightly higher write-offs against non-performing loans, but I think that's more or less being conservative. But I think that it bodes well for the upcoming year or two, because it looks as though M&A is picking up and deal making is picking up, and it should be good for all the big bulge bracket banks. You refer to yesterday as being quite a day on the markets. I assume you're referring to the U.S. inflation numbers. Have those numbers reset your expectations on what the U.S. Fed may do and where markets may go? Yeah, it's interesting. If you look at what's been going on in markets, the average stock put in a high at the end of March, beginning of April, and then spent the last 3 months churning sideways, while the very largest of large cap tech stocks, you know, carried the S&P higher and higher. And so it was a much narrower market over the last 3 months. And of course, the market rallied from October into the end of March, and you know, markets correct two ways, in time or in price. What's important is that in the last 5 days, first the NASDAQ 100 equally weighted index went to a new high. And then yesterday, the equally weighted S&P made a new high after not making a new high since the end of March. So it looks as though that sort of coiling period or consolidation period has resolved. And, you know, we were at a point a week ago where for the year, only 25% of companies in the S&P were beating the S&P index, which is the lowest percent going back to 1974. So it was important to see the market start to broaden. And yesterday, of course, we had I think the 6th standard deviation day where the Russell 2000, you know, the outperformance was breathtaking. So that was probably some short covering, but also some real buying, because the inflation data came in lower. It means that probably it brings forward the Fed's cutting of rates, makes it more of a certainty for September at the latest, and ultimately good for the broad market. Do you think July is possible for a U.S. Fed rate cut? Our first guest of the morning, Earl Davis at BMO Capital Markets, is confident in a July cut from the U.S. Fed. Yeah, we've been talking about this internally at Barometer for the last month or so because of the weakening data. And I think this put a punctuation point on it. So leading up to yesterday, I wouldn't have said it was a probability, but I think it's a real possibility that we get a cut in July. It's certainly baked into the cake for September. Either way, we're into a global liquidity cycle now. Last month was the first month since the middle of 2020 where there wasn't a single central bank globally that raised rates. And so now we're into a loosening cycle, and that, you know, liquidity drives markets. Single most important thing. And of course, over the next 2-3 weeks, we're going to get a substantial number of S&P 500 companies reporting. And the estimate is for 9% earnings growth, which is a substantial pickup over last quarter and the quarter before. So the combination of earnings and looser monetary conditions is a good combination for stocks. The TSX composite has caught fire recently. It's been the material stocks and the energy stocks that have pushed it higher this year. Can that continue? Yeah, we're big believers in both of those sectors. both sectors went through close to a decade of a bear market. The energy sector went down 90% from 2014 through 2020. Now they had a nice run out, and during the tightening cycle, they consolidated. Materials and energy both had a great start to the year. I think the materials stocks were up about 50%, and then they pulled back about a third of that during April and May, which would be typical. But over the last 2 weeks, they've caught a bid again. And that's good for global markets because there's a lot of energy and materials in global markets, and it's good for the TSX, which means we could see some outperformance in global stocks and TSX index that we haven't seen in quite some time.